If you think Ontario budget is just politics, you're missing one of the most important forward-looking real estate opportunities document in this country. Because inside this budget is over $210 billion in infrastructure spending. And that's not just spending. That's a roadmap for where rents will grow, where land value will shift, and where investors will either get ahead or get left behind. Most people will read headlines. Serious investors, they read what this actually means for cash flow, risk, and long-term positioning. Welcome to Smart Real Estate by LearnInvestManage.com. I'm Addy Saeed. Today we're breaking down the Ontario Budget 2026, specifically infrastructure and housing, through a multifamily investor lens. This is not a policy breakdown. This is demand mapping, risk identification, and opportunity positioning. If you're listening to this and actively investing, drop a comment. Which market are you focused on right now? Because what we're about to go through is going to affect Toronto, the GTA, and secondary markets very, very differently. Let's get into it. The province is committing over $210 billion over the next decade. That's one of the largest infrastructure programs in Canadian history. Now, here's the key idea. Infrastructure doesn't follow growth. It forces growth. From a multifamily perspective, this creates three major shifts. New demand nodes, transit and highways expand where people can realistically live. Cap rate compression, selectively. As area becomes more connected, they become more investable. Population redistribution. People don't just move to cities anymore. They move along infrastructure corridors. So when you're buying an apartment building today, you're not buying based on what the area is today. You're buying based on what the province is turning it into. Let's start with highways, because this is where a lot of investors underestimate impact. Major projects include Highway 413, the Bradford Bypass, Highway 401 expansion and tunnel study, Highway 7 expansion, Highway 400, and Highway 404 widening. Now, here's the investor takeaway. Commute time is everything. If you reduce commute time by even 20 to 30 minutes, you effectively expand the rental footprint of Toronto. Markets like Barrie, Bradford, Milton, Cambridge start behaving less like secondary markets and more like extended commuters market. What does that do? It stabilizes rent demand, it supports rent growth, and it attracts tenants who are priced out of the core urban areas. But there's a flip side. The risk is supply overshoot. When infrastructure opens up, developers flood these areas. And what happens? Supply hits before demand fully matures. This creates lease-up risk, rent softness, and investor underperformance. Here's an insight. Highway-driven growth is real, but it's not immediate. There's a lag, and that lag is where a lot of investors get caught. Now let's talk about what actually drives premium multifamily performance: transit. So major investments in the document include Eglinton LRT, now it's operational, Finch West LRT, Ontario Line, Yonge North expansion, and GO expansion across multiple corridors. So here's the core thesis. Transit doesn't just improve mobility, it redefines rental economics. So rental proximity means pricing power. Properties within walking distance of transit will lease faster, experience low vacancies, and command rent premiums. Policy-backed density. The province is planning 292,000 homes across transit nodes. That means density is no longer optional, it's being engineered. And institutional capital follows transit. Large capital, pension fund, and REITs, they don't speculate. They follow infrastructure stability and predictability. So as a strategy, if you align with transit, you're aligning with government policy, you're aligning with capital flows, and you're aligning with long-term demand. But let's talk about supply, because this is where returns are made or lost. So the key changes that are coming through. So there's a removal of 8% provincial HST on purpose-built rentals. There's also an incentive for municipalities to reduce development charges. There's condo to rental conversion program, and there's modular housing pilots. Let's talk about HST removal. This is important, but it's not a silver bullet. Yes, it improves development feasibility, but it does not solve the high construction costs, the expensive financing, and the labor shortages. There's condo to rental conversions. The province is funding conversions of about 2,200 condos into rental. That's a signal. The condo demand is weakening, and rental demand remains structurally strong. So this province is encouraging movement of condo units into the rental supply, into the rental pool. Supply constraints are still real, even with incentives. Approvals are slow, servicing is limited, and municipal processes are fragmented. There's a distress signal here. Developers are getting caught between high interest rate, slow condo sales, and rising costs. This creates a joint venture opportunities. It will create discounted acquisition and stall projects entering the marketplace. And this is the hidden layer, the servicing infrastructure. This is where sophisticated investors pay attention. The province is investing heavily in water, wastewater, and stormwater system, including enabling up to 800,000 homes through infrastructure program. Why this matters? No servicing means no developments. Land without infrastructure is not usable. So as an investor, you should be tracking municipalities receiving funding and infrastructure expansion zones. because those areas represent future supply pipelines and future competition. And this budget isn't just about growth. It's defensive. The promise is responding to economic uncertainty, trade pressures, and slowing global conditions. And what are they doing? They're using infrastructure to create jobs, stabilize the economy, and support population growth. For multifamily investors, that supports tenant stability, rent collection, and long-term demand. But it also introduces inflation risk, long-term rate pressure, and financing sensitivity. So let's simplify this. The strongest opportunities that we see are transit-oriented multifamily, secondary markets with improved connectivity, value-add near-future infrastructure, and developer distress situations. The key risk that we are outlining is oversupplied suburban markets, aggressive rent assumptions, condo-heavy investor zones, and areas without transit banking. The big insight: this budget is not about today. It's about where Ontario is forcing growth and where capital will inevitably follow. If you want a city-by-city breakdown of where to invest based on this criteria, comment deep dive and I'll break down Toronto, Durham, Hamilton, Kitchener-Waterloo from an investor perspective. Also, if you don't follow us, follow along and we'll do those deep dives live on this channel as well. So in closing, infrastructure is not neutral. It determines which market outperforms, which assets stabilize, and where risk quietly builds. If you understand these shifts early, you're not reacting to the market, you're positioning ahead of it. What markets are you investing right now? What are you seeing in terms of rent growth or softness? Drop a comment below. For deeper insights, tools, and analysis, visit learninvestmanage.com. This is an ongoing conversation. No hype, no shortcut, just real analysis for real investors. The goal of this show is to help investors learn, invest, and manage with clarity and confidence. This podcast is for informational and educational purposes only. Nothing discussed should be considered financial, legal, tax, or investment advice. Real estate investments involve risk, and past performance are not indicative of future results. Always consult with a qualified professional before making any investment decisions. Any examples, discussions are for illustrative purposes only. I'm Addy Saeed. Until next time.